Today we will be discussing fixed and flexible budgets. A fixed budget is a budget prepared based on a single predicted activity level, such as sales volume. An example is a budget created based on the assumption that 10,000 units would be sold in the period. A flexible budget is a budget that is adaptable to any desired activity level. Examples include budgets adapted to the assumption that 10,000, 12,000, or 14,000 units will be sold. In general, a flexible budget is more useful than a fixed budget for managers, as predicted activity levels are rarely exactly as budgeted. If the company budgets to sell 10,000 units in a period and they actually sell 11,000 units, we would expect many of the costs, most notably the variable costs, to be higher. Therefore, a fixed budget built assuming only 10,000 units will be sold will tend to underestimate variable costs. We need a flexible budget that can adapt to any activity level. Given the level of volume and the classification of all costs as either fixed or variable on a fixed budget, we can create a flexible budget. Let's look at an example. Here we have the fixed budget for Ellison Enterprises for the month ended October 31st, 2021. This budget was prepared assuming that 2,000 units would be sold in the month, but the company actually sold 2,200 units, so this budget really isn't all that useful for us. We are given the fixed budget and the actual results, but it really doesn't make a lot of sense to compare these amounts since the budget assumed only 2,000 units were going to be sold, and again, 2,200 were actually sold. So I'm going to delete the column with the actual results for now, and we'll come back to it later once we've created our flexible budget. Looking at what we have now, conveniently the budget is in contribution margin form, with the fixed and variable costs in separate sections. Remember that any variable cost, or variable revenue in the case of sales, increases proportionally to the number of units produced. So any variable cost or revenue in the fixed budget carries an assumed variable amount per unit. So what I'm going to do is I'm going to set up another column here called var per unit, meaning variable amount per unit. First, let's look at the sales, which are assumed to be variable. When this company sells more units, more revenue is earned. If the fixed budget was prepared under the assumption that 2,000 units would be sold and the budgeted sales are $300,000, that means there's an assumed selling price of $300,000 divided by 2,000, which equals $150. We can do this same process for all variable costs. Take the variable cost and divide by the 2,000 units that were budgeted to be sold. For direct materials, we have 54,000 divided by 2,000, which equals $27 per unit. For direct labor, we have 20,000 divided by 2,000, which equals $10. Hopefully you can see the pattern here. When we take the remaining variable costs and divide each of them by 2,000, we get $5 of variable overhead per unit, $3 in sales commissions per unit, and $20 in shipping expenses per unit. Adding up all of the per unit variable costs with the sum function here, we get $65. You could also get $65 by taking the total variable cost in the fixed budget of $130,000 and dividing by 2,000. The contribution margin per unit is the sales price per unit of $150 minus the total variable cost per unit of $65, which equals $85. Again, if you wanted to, you could take the $170,000 of total contribution margin and divide by the 2,000 units to get the $85 that we just got. Now it's important that you don't apply the same process to fixed costs. Fixed costs by definition don't vary by unit, so there is no need to calculate a fixed cost per unit for the purposes of creating a flexible budget. So I'll just use dashes in here for the fixed costs. At this stage, we are ready to create the flexible budget. So I have now discarded our fixed budget because it's really of no use to us anymore, and have brought back the actual results, which you can see here. I have the variable amounts per unit off to the side, and I have left a column here for the flexible budget, which we will now calculate. We will also get to calculating variances, but I won't talk about that yet until we have finished the flexible budget. For any item that we expressed as a variable amount per unit, we take the actual units sold, which are 2,200, and multiply by the corresponding variable amount per unit. Starting with sales, 2,200 actual units sold times the $150 variable selling price per unit equals $330,000. If you remember back to our fixed budget, You might recall that budgeted sales were only $300,000, a gross underestimation based on the 2,200 actual number of units sold. We can do the same process for all of the variable costs. 2,200 times 27 is equal to $59,400 of budgeted direct material costs. 2,200 times 10 equals $22,000 of direct labor costs. Using the same process, we get the variable overhead to be $11,000, the sales commissions to be $6,600, and the shipping expenses to be $44,000. Adding up all of the variable costs from the flexible budget gives us $143,000. We can find the contribution margin by taking the sales of $330,000 and subtracting the total variable cost of $143,000, which gives us $187,000. Now for the fixed costs, remember that they don't vary when volume changes, so the number of units sold doesn't make any difference. So we can use the exact same budget amounts that we used on the fixed budget. You can see here that the fixed costs are budgeted to be $10,000 for administrative salaries, $2,000 for rent expense, and $3,000 for the insurance expense. So we can copy those over to our flexible budget. Adding up the three fixed costs gives us $15,000 in total budgeted fixed costs. The contribution margin of $187,000 minus the total fixed cost of $15,000 gives us the income from operations of $172,000. Okay, now we are ready to work on the variances. A variance occurs whenever there is a difference between the budgeted amount and the actual amount. So for example, we see here that there is a $5,000 difference between the flexible budget sales of $330,000 and the actual result of $325,000. We label variances as either favorable or unfavorable. Favorable variances lead to a higher net income than budgeted. Unfavorable variances lead to a lower net income than budgeted. So if we think back to the $5,000 variance that we had for sales, this will be an unfavorable variance, which we can label with a U because the actual sales are lower than the budgeted sales. Lower actual sales leads to a lower income than was budgeted, which is why this variance is unfavorable. It's important to note that we don't use negative signs when writing out variances, only the label as F for favorable or U for unfavorable. Moving down to direct materials, the difference between the budget and the actual result is $1,100, and this variance is unfavorable. Why? Well, because the actual cost is higher than the budget. We have more costs than budgeted, which leads to lower net income, and an unfavorable variance. The direct labor variance is $1,000 and is also unfavorable, since the actual cost is higher than the budgeted amount. Hopefully you can confirm that the variance is favorable for the next three costs. We can see that the actual results are lower than the budget. Having lower costs than the budget is good and ultimately leads to higher income than budgeted. The variances are $500 favorable for the variable overhead, $400 favorable for sales commissions, and $500 favorable for the shipping expenses. Next we look to the total variable costs, which are $143,700. This is $700 more in variable costs than we budgeted, so we exceeded the variable cost budget, which is an unfavorable outcome. The actual results contribution margin is much lower than the budget. Remember that a higher contribution margin is a good thing. It's a measure of income, so having a lower contribution margin is unfavorable, and the amount is $5,700. The only fixed cost with a variance is the administrative salaries. The actual costs exceed the budget. The other two fixed costs do not have any variances, making for a total fixed cost variance of $100, which is unfavorable. Finally, the income from operations is lower than budgeted by $5,800, which is an unfavorable result. Our flexible budget had us making more income than we actually did, so not meeting the income goal is an unfavorable result. Alright, that completes our flexible budget. I just want to remind you that we created our flexible budget assuming that 2,200 units would be sold, but of course inherent to the idea of a flexible budget is that it could be adapted for any amount of units. So you could create a flexible budget for 2,300, 2,400, or any other number of units sold, which is what makes the flexible budget so useful.